Staying with the wider crypto fallout, since FTX filed for Chapter 11 bankruptcy protection last week, other industry heavyweights have been vocal about their position in relation to the exchange. Coinbase, for one, has said it has minimal exposure to the company and none to its native FTT token. Goldman Sachs cut its price target on the stock Friday, but said it is, quote, sufficiently insulated from the fallout. Now, fintech group Circle also weighing in. That's the firm behind the USD coin. CEO Jeremy Allaire took to Twitter to say the company has never given loans to FTX or Alameda. He's been calling for greater transparency and accountability for the wider industry. And we're lucky to have him on with us today. Let's bring in Jeremy Allaire along with our very own David Hollerith. Jeremy, let's get to the very point that you have been really raising for a while. It is these offshore exchanges that you say just are not under the same scrutiny that American ones are. Does this put exchanges like Coinbase in a stronger position now?
I think that companies that are principally operating out of the United States and have subject themselves to both state and federal supervision should be, and I think are, advantaged in this phase of the market. And I think when you look at the requirements of running a national scale financial institution or a global scale financial institution in a regulated capacity, there's just fundamental things that you have to have in place around your financial controls, your risk controls, the amount of scrutiny that you have and examinations that you have around your business. And American regulators are among some of the strongest in the world. Coinbase obviously is a publicly listed company. Circle is in registration with the SEC and is a public filer. And I think that whether you're an institution or an individual, whether you're thinking about what exchange to be using, what wallet to be using, or what stablecoin to be using, you're going to be looking for the rigor that goes into being a regulated American financial institution. And I think that is going to strengthen companies like Coinbase and is certainly going to strengthen companies like Circle as well.
And Jeremy, if I have it correct, back in July 2021, Circle actually joined FTX's Series B. And obviously a lot has changed since then. And Circle is by no means alone in investing in FTX. But I was curious about sort of the conversations going into that process, what the due diligence process looked like. What was the impression on Circle's end about FTX at that point?
Yeah, so Circle has a venture investing activity. We invest very small amounts in a lot of different companies across the broader digital assets ecosystem. I think we've made about 100 investments. The investment in FTX was a very, very small investment. We are by no means a lead investor. We were not leading any kind of diligence activity in the company, more of a passive add-on investor at a very small scale. So we're not really a principal, as I would say, in those kinds of activities. But what I can say is, I think at face value, the numbers that FTX was putting up and the growth that they were demonstrating in FTX's business and their emerging U.S. business were incredibly impressive. I think those are known. And that was certainly during a time of significant growth in this industry. I think not having visibility into the underlying financial management, risk controls, treasury management, and other things, certainly has caught everyone by surprise. But it does, I think, suggest that companies that are controlled by single shareholders, that lack boards of directors of any substance, that are not subject to significant and strong supervision on a cross section of major control issues, introduce significant risk. And there are major reasons why in the United States financial system, there are market conduct rules that deal with conflicts of interest. Banks can't run exchanges. Exchanges can't run market-making businesses. These separations have grown out of the fact that these conflicts of interest can create major issues. And that's above and beyond just the fundamental kind of risk management and supervision side of this.
Jeremy, a broader question here. This idea of a decentralized financial system with blockchain technology underlying it. I mean, this is something that came out of the financial crisis that really exposed just how much power was concentrated in the traditional financial institutions, how much the opaqueness existed. I mean, this is a system that was supposed to offer more transparency. Does that argument still hold in light of what has played out?
I think it does. I mean, the irony here is that some of the biggest institutions, financial institutions that have been built up in the crypto space are these very centralized, opaque, most of them operating offshore without any real regulatory supervision. And frankly, most of them focused on creating platforms for speculators and creating platforms that are fundamentally focused on people who are speculating on digital tokens. And so that is certainly not what the promise of this technology represents. When I founded Circle with my co-founder over 9 years ago, we were focused on how do we take traditional money like dollars, create digital currency versions of that, how to operate that on these public, open, transparent networks, create a more efficient, inclusive, transparent, and auditable financial system. And we're still making great progress towards that. But I think it underscores the need now more than ever to focus on pivoting from this speculative value phase of crypto, which has produced some spectacular gains, but also some spectacular failures and losses, and move on to the utility value phase, which is so critical and which builds on that fundamental anchored philosophy around building a public, transparent, and auditable financial infrastructure on top of these blockchains.